a few factors that I think are important here, okay? So in terms of truflation numbers, for the month of May, it pretty much had us consistently in the threes, right, when it came to truflation. At the very, very, very end of the month, it had us in the twos, but pretty much the whole month we were in the threes. U.S. government numbers came in at 4%, okay, so which means truflation numbers were off anywhere between, let's call it 0.5% to 1%, roughly, okay? Now, this month, for the month of June, truflation has had us pretty much, it has had us at 2% or below, or excuse me, in the twos, right, the entire month, literally the entire month. So what it looks like is the next U.S. government numbers will probably come in at like a 3.1 to 3.3 number, right, because we know it's not going to come in low like truflation numbers are, even though I trust truflation numbers a lot more than I trust the government numbers, but the government's going to make moves based upon what truflation's at. Or excuse me, the government's going to make moves based upon what their numbers are at, not what truflation's at, right? Now, an important thing to understand about that is when the government numbers come in at 3-something next month, the Fed's going to be in a real pickle to try to raise rates when you got Fed funds rate right now over 5%, and you got a situation where the CPI is going to come in at probably a low 3 number. That's a tough position to kind of take there. Now, Jerome Powell is still talking tough. He's still talking very tough. It hasn't been restrictive nearly long enough. We're going to have to stay restrictive for longer. We're going to have to potentially raise rates more. All these things. He's talking a big game. He's talking tough. Why is he doing that? The reason he's doing that is he can't call victory yet. At the end of the day, the government numbers came in at 4%. 4% is not in the twos, okay? 4% is not 2%. He can't call victory yet. He also doesn't want the market to get too excited. He also doesn't want commodities to start running, okay? And so that's why ultimately at the end of the day, he's still talking tough, and he's going to continue to talk tough until we get comfortably in the twos, month after month after month. This is GSG. This is the commodity index that you pretty much want to track to kind of see commodities over time, right? And I mean, this is down 20+% in the past year or so. And we're in a situation where, commodities continue and remain in a massive, massive downtrend. That's obviously going to be great for getting inflation numbers down. And the more the market potentially runs, or we're seen as going risk on or anything like that, the higher the probability is that commodities can run. And obviously he doesn't want that, or we're going to have another spike of inflation, right? Which would be no bueno. So that's what's going on there. That's why Powell's talking tough, and why he's going to continue to talk tough until we've, officially won the battle when it comes to the government numbers, okay? Very, very big comment there from Mr. Roger Ferguson here, okay? Huge comment from him, actually, that he believes 3 rate hikes are basically coming likely within the next, let's just call it 9 months, okay? That's basically what he just said there. Intriguing. It's a possibility if inflation spikes huge again, but based upon what we're looking at, and based upon the fact that CPI should likely come in the 3s this upcoming month, and we should be on a trajectory to hit 2s for the government numbers likely within a month or 2 after that, it gets difficult to try to predict there's going to be 3 more rate hikes unless you have another big spike of inflation. In order to get another massive spike in inflation, you need commodities to go through another big super cycle. Without commodities really going through another big super cycle, you're not going to get, because remember why inflation spiked huge. It's because commodities went through their biggest boom cycle coming off of Rona, right, into the next basically 18 to 24 months. That's the biggest bull cycle in commodities we've seen probably ever. And certainly since, decades and decades. Like, we have never seen it like that insane. You go back and look at commodities from like April 2020 through, let's just call it April 2022. Ridiculous. And then you had supply chains completely messed up at that time, which just caused a bunch more inflation. Plus, you had government pump just a ridiculous amount of money out there to consumers. And that's why we got that crazy inflation. So, now they're so worried about this thing, and it's like you don't really have the ingredients. You don't have the ingredients to have a massive another spike in inflation. You just don't. You don't have the supply chain problems there. You don't have the insane government stimulus now, and everybody gets a stimulus check and all this stuff. And you don't have commodities going through any sort of super cycle. So you don't have any of the ingredients on why we actually had massive inflation. So that's where to make a prediction of 3 rate hikes, in my opinion, is a pretty irresponsible thing to do for a former vice chairman of the Federal Reserve. That's just, understand why we actually had inflation. Foot Locker stock. It is a value and dividend play, okay? Now, Foot Locker is a stock that's gotten hit pretty hard over the past year. I think it's a pretty easy opportunity as a pick-off like value dividend play here. Not a huge amount of risk. It's kind of been de-risked on the price side now at this point in time. And they have a new let's call it sheriff in town at Foot Locker, okay? She just took over this company, a few quarters ago, essentially. Mary Dillon, all right? Basically, she was bored, and she said, I want to be CEO again, okay? And so Mary Dillon, if you don't know, she spent 8 years as CEO of Ulta Beauty. Now, during her tenure at Ulta Beauty, they nearly tripled the business, okay? Nearly tripled the business, one of the most successful runs in modern retail history. Mary Dillon is the real deal Holyfield. She's a extremely proven CEO, and I mean extremely proven. She's on the board of directors of Starbucks and the board of directors of Ulta as well, right? She's shaking things up inside Foot Locker, where she's basically getting them out of some stores, out of some businesses, and really identifying where the real opportunities are. So basically, it's kind of like a restructuring year, basically. This year is kind of like a restructuring year. She's taken over as sheriff and saying, we're getting out of some of these, businesses and some of these stores, and we're going to expand over here, okay? So she's shaking things up, and she's basically identified that we need to close in our relationship with Nike, which it looks like absolutely they're doing, and we'll definitely start to bear the fruits of that, in my opinion, at the end of this year and really going into 2024, okay? She's a real deal Holyfield. If you're going to ask me for a CEO to lead a retail company, she's going to be right up at the top of the list in terms of people I'd want to run my business, okay? Now, Foot Locker, here's the deal, okay? And this is why it's so de-risked right now. We know they're going through a restructuring mess this year. So let's say EPS is around $2, which is a pretty low number. You're trading at a this year PE of roughly 12 to 13. That's extremely low for it being a restructuring year. Based upon what they're expected to earn next year, $3 plus, it's under a 9 forward P for next year's numbers. Come on, man, okay? That's far too cheap for a company like this. And if you look at something like an Ulta, right, which is very respected, they trade at like a 17, 18 range for forward Ps. So I believe Mary Dillon over the next few years is going to get Foot Locker to a place where they'll be respected like that, and they'll command that sort of, forward P, which gives kind of a double up opportunity just from like the respect angle of the business model, never mind what she's going to do for kind of growth numbers over this next few years in regards to Foot Locker, right? Now, here's a beautiful thing. While I wait for the stock and I wait for, all the things to prove out and Mary Dillon to work her magic here, I get to collect a 6% dividend yield for just chilling and holding the stock. And so that's pretty extraordinary, right? To collect all that dividend money every single quarter, gets, paid out to my account. It's phenomenal. I absolutely love that, right? And if we go ahead and look at their total equity, this is fascinating. They have total equity right now of, let's call it about $3.3 billion. That's far less than their market capitalization today. I mean, we're talking many hundreds of millions of dollars less. So I'm getting basically the equity of the company for less than the market cap right now. And that creates an extraordinary opportunity, right? So basically, I'm willing to buy this stock all the way to $40 a share. After 40, it's just a hold for me at that point in time. But that's where I'm willing to buy this one, okay?